go straight to your questions. Libre à vous de poser des questions dans la langue officielle de votre choix. We'll do one question and a quick follow-up for the first round. Simply indicate to me if you'd like to ask a question and state your name and affiliation. There's a little microphone on the table in front of you. You just have to push the button before you speak. And so now with that, I'll turn it over to Governor Poulos.
Well, thanks, Louise. Good morning, and thank you for being here today. Senior Deputy Governor Wilkins and I are pleased to be with you to talk about the latest issue of the bank's financial system review, which we published this morning. Let me quickly remind everyone about the purpose of the FSR. It's to identify key vulnerabilities in the financial system which can interact with and magnify economic shocks. We monitor the evolution of these vulnerabilities and then apply a set of risk scenarios to look at the potential implications for the financial system and the economy if a significant shock were to occur. Les principales vulnérabilités que nous observons aujourd'hui sont les mêmes que celles exposées dans la livraison de novembre dernier de la revue. J'aimerais commencer par dire quelques mots sur deux d'entre elles, soit l'endettement élevé des ménages et les déséquilibres sur le marché du logement. Ces vulnérabilités devraient persister quelque temps, même si nous constatons encore des signes d'atténuation. Plusieurs facteurs ont contribué à atténuer la vulnérabilité liée à l'endettement des ménages, notamment une série de modifications apportées aux lignes directrices sur le crédit hypothécaire. La croissance du crédit a aussi ralenti, parallèlement à la hausse des taux d'intérêt. De plus, l'expansion vigoureuse de l'économie canadienne est en train d'entraîner une forte croissance d'emplois et de revenus. Avec le temps, cette erreur, les Canadiens géraient leur dette, même dans un contexte de montée des taux d'intérêt. The changes to mortgage lending guidelines are driving a steady improvement in the quality of new loans. We've seen a decline in the share of mortgages that have a loan-to-income ratio above 450%. In fact, the share of new insured mortgages with a ratio above this threshold has been cut in half since the middle of 2016. This is an important improvement because we know that households with this level of debt are more vulnerable to an economic shock like a recession. However, I'll point out two reasons for continued vigilance. First, because the total amount of debt carried by Canadian households is so large, we know that it will be with us for a long time. Second, it's still too soon to fully assess the impact of the newest changes to mortgage lending guidelines. These guidelines, which came into effect at the start of the year, were aimed at tightening standards for uninsured mortgages. It's not yet clear whether the guidelines are driving a significant amount of activity away from federally regulated institutions and toward private lenders and credit unions, who may not follow the federal guidelines. This is an issue that we'll monitor. We're looking forward to lending data from the second quarter, as well as the latest information from CMHC about mortgage underwriting practices, which we'll receive later this year. Now, in terms of housing market imbalances, we've also seen some lessening in this vulnerability, though it remains elevated. The annual rate of house price growth peaked in April of last year at just under 20% on a national basis. Now, it's below 2%. This slowdown is due to the declining affordability of housing in some markets, as well as the combined impact of higher interest rates, macroeconomic policies such as the new mortgage lending guidelines, and housing policy measures taken by various provincial governments. Of course, that figure is a national average. Outside of Toronto, national house price growth remains above 5%. A decline in prices for single-family homes in Toronto is a major factor pulling down this national average. In contrast, prices for condominiums are still growing rapidly, particularly in the Greater Toronto and Vancouver areas. This is a reverse of the dynamics that we saw until early 2017, when price growth for condos trailed the price for single-family homes. It's possible that the guidelines are having an impact here by limiting the amount some buyers can borrow and increasing the demand for condos relative to single-family homes. It's also possible that speculative activity is helping to push prices higher. La troisième vulnérabilité que nous surveillons concerne le risque qu'une cyberattaque d'envergure touche une institution financière ou une infrastructure de marché à l'image des systèmes de paiement. Notre système financier est si interconnecté que l'on peut craindre la portée des effets d'une cyberattaque qui toucherait une institution. C'est pourquoi la Banque collabore avec les grandes banques et Paiement Canada à la mise en place de mesures qui garantissent la reprise rapide des activités de nos principaux systèmes de paiement dans l'éventualité d'une cyberattaque. Overall, when we look at the three vulnerabilities and our risk scenarios, we judge that the overall level of risk is roughly unchanged from November, and our financial system remains resilient. I also want to point out that in this FSR, we report the results of a survey that we conducted with financial system participants. Respondents identified the threat of a cyber attack, geopolitical events, and a pronounced decline in property prices as among the most important risks facing their firm's own activities and the broader financial system. Now, before we answer your questions, I'll turn it over to Senior Deputy Governor Wilkins, who will say a few words about the bank's plans for communications on financial system issues. Carolyn.
Thank you, Governor. Well, as many of you know, for over a decade, our biannual financial system review has been our main vehicle for communicating our analysis and our research on developments related to financial system stability. Now, the financial crisis taught us in the hard way just how important it is to keep on top of financial system risks. And that's as true today as it was then. And so I'm pleased to tell you about some changes that we're making to improve the accessibility and the timeliness of our work here. The first is that this autumn, we will launch the Bank of Canada's Financial System Hub on our website. The Hub will offer up-to-date analysis and articles on the financial system issues at hand, and they will be presented in a timely and engaging way and aimed at a broad audience. The goal is to help more Canadians better understand financial system developments without having to wait for a full FSR to be published. The second change is that we will publish the Financial System Review once a year in June. This just recognizes that main vulnerabilities facing the financial system tend to evolve very slowly. Comme le gouverneur vient d'indiquer, les trois grandes vulnérabilités, de même que le niveau de risque global, sont les mêmes que lors de la dernière livraison. Le troisième changement est que chaque automne, un membre de conseil de direction prononcera un discours qui fera le point sur l'évolution des principales vulnérabilités du système financier et des principaux risques. Ce discours tirera sa matière des analyses publiées sur notre nouveau portail sur le système financier sur le site web de la Banque. Le concept est très similaire à celui des discours périodiques sur l'état de la situation économique que nous avons mis en place plus tôt cette année. We will also use our quarterly monetary policy reports to discuss relevant financial system issues when they have a bearing on the outlook for economic growth and inflation. The bottom line is that we are modernizing our financial system communications to be more nimble and to give these issues the greater visibility that they deserve. And with this, Governor Polis and I would be very pleased to take your questions.
Merci, Madame Wilkins. So we'll go to questions now, and we'll start with Kim.
Hi, thank you. My question is about the reference to speculative activity in condominium markets, and I think the report outlines specifically that issue in Vancouver and Toronto. Can you just expand on why you see that as a concern? Are real estate markets in those two cities separating in terms of much less concern in detached housing versus in condominiums? And to what extent is there a concern about a possible correction in the condominium market now?
Sure. Well, what we observe in those two housing markets, so the Greater Toronto area and the Greater Vancouver area, is that they are showing the effects of the increases in interest rates that we put in place, but also the effects of the macroprudential measures, especially the B20 stress test that was implemented in January, that are working to really weigh on housing resales. Part of that is just because people pulled forward their purchases in the fourth quarter last year, and so you get a temporary lull. I mean, part of it is expected in terms of slower growth. And what we've observed is that the growth slowing is particularly strong in the singles market as opposed to condos. In fact, you'll see some charts in the financial system review that show that condo market's still doing actually pretty well in those two areas. A part of that has to do with affordability. The housing prices for singles just got so high that affordability started to weigh on it as well. And so people are transferring their desired purchases to housing that's more affordable. We have seen declines in resales. When you look at the permits and the housing starts, they still remain firm. And so, as we said last week in our monetary policy press release, we do expect the housing market to stabilize. It may take a little bit longer than we thought in April, but the fundamentals that are there, in terms of a strong labor market in those regions, as well as the supply constraints just on the amount of housing, they're still in place.
Thank you. And I'm going to ask a question about tariffs. Since you did a press conference here in Ottawa last, the U.S. announced tariffs on steel and aluminum, and I'd like to ask how that affects both the economic outlook and the outlook for financial stability in Canada.
Well, as is our typical convention, we incorporate all government policy announcements that we're able to into our forecast. And so that'll be a job for the July MPR to actually address these specific tariff changes. So I don't want to speculate on how that will come out, but I can touch on the complexity that lies behind it. I know it sounds like a rather simple thing, 25% on this and 10% on that, just put it in your model. But in fact, that's one product or two products which are present in a variety of stages of production, various supply chains. You may not be a producer of aluminum, let's say, but you're a big user of aluminum, or same with steel. And you may be at stage 3 in the supply chain, and these things are getting passed down through your supply chain. So in short, the response of the economy to such a thing is rather a complex analysis, both on the production side, because it may vary from firm to firm, whether they have already a cross-border kind of presence and are able to adjust differently than companies that do not. And so it varies by firm, and it varies by sector, of course, how important the product is in their sector. And then there's the whole story of the consumer, which we can't forget. But often the conversations are not about consumers. They're generally about firms and do they have a level playing field, et cetera. But throughout all this, the consumer, we're confident, will end up paying more for many things. So that has, of course, an impact directly on inflation measures. And it also has a direct impact on real spending power. And so this is why when we talk about trade, in general, we talk about trade being a positive sum game. That is that everybody wins when more trade happens, because not only do firms specialize in what they do best and are most efficient at, but consumers get the lowest price that's available to them of those things. When trade is peeled back in some form, in this case through tariffs, the reverse happens. And that includes the gains that consumers get from trade. Those gains are reduced. And that's the sense in which reducing trade is a negative sum game. Everybody loses in some way or another. And so putting numbers against those is a lot harder than I just made it sound, but it is a very complex thing. We'll be doing our best to address this. For the moment, I think we've already captured the channel of uncertainty. I think that's the most important channel because it's mostly about how do firms position themselves for the future, how do their investment plans get affected by these things. And that channel we've emphasized before and is already incorporated in our forecast as an uncertainty channel. And we'll have to take another look at that, how big those things are, and we'll have conversations with companies through our BOSS survey. So that'll also be helpful.
The next question is from Greg.
That the size of the debt and the impact of that will be with us for a long time. Can you elaborate on whether we're in some kind of house poor world here?
Well, I think on the contrary, actually. I mean, the reason why stock of debt is so elevated, I went into that in some detail in that speech up in Yellowknife. We have a high level of debt because interest rates have been so low. And so the sorts of debt service obligations that households are carrying are not really that different from what they've been historically. Now, of course, as interest rates move higher, there's of course the chance that debt service ratio for the economy as a whole will rise. But historically, it has not been that sensitive to interest rate movements. People manage to a certain debt service ratio. And so, I think that the consequence of this era of very low interest rates has been that people have been able to buy houses, possibly larger houses or better located houses, et cetera, than they were, say, 20 years ago when interest rates were higher and debt service was, potentially, for the same house, a bigger share of your income. So no, I don't think of it as a house poor as you characterized it situation, but acknowledge that, of course, as interest rates rise, we are exposed to that, and we expect the sensitivity of the economy to those higher interest rates to be higher, because for every dollar of debt, a higher interest rate means there's less cash flow left over for other consumption goods. And so we'll be monitoring that very carefully as we go about this gradual process.
Physically, you've mentioned this report is going to a once-a-year affair now. Is that supposed to be another signal that the dangers in housing have basically moved down a big level now?
I wouldn't take that. We're moving to once a year for the financial system review, the full review, as a sign about any view on the vulnerabilities. In fact, when we think about a modern way to communicate, and we got feedback from the people who read our material and other discussions, we realized that there's a limited taste these days for people twice a year to read a document that's 60 pages long. And that if we broke it up a little bit by putting out the analysis, for example, in the reports, more gradually throughout the year as they became available, that not only would be more relevant, it would be more likely to be read. Because it was timely instead of waiting till December or waiting till June. And so, in fact, it's an attempt to be more modern, more accessible, and more timely in our analysis. An example is you'll see a table in the financial system review about when we're going to get data that will help us tease out the effects so far of the recent changes in B20. And we think, we'll get some really good data accumulating up till September. And so sometime, maybe the end of September, October, we'll have a paper that will do that. We think, why wait till the end of November to put that out? We'll put it out on our new financial system hub, and you can get our analysis right away. And so that, combined with a speech by a member of Governing Council in the fall, which will wrap all our updated views together, I think will be a more effective way to communicate how we're viewing vulnerabilities and risks of the financial system.
Andrea?
Thank you. I wanted to follow up on, your thoughts on the housing market, that there's some stability there and, income's rising, it's coming back. Maybe the worst is behind us. I'm wondering, you mentioned incomes, but is there enough credit to support demand with these tighter mortgage rules?
Well, we are seeing a modest moderation in credit. That's exactly, of course, what we would expect to see as interest rates go higher. You would expect to see a moderation. But this, of course, is always there's a big piece of collateral in housing credit. And so what I really think it points to is that these rules around mortgages, of course, are at the margin reducing the size of the mortgage at the maximum size of mortgage that someone can obtain given their income. And that is quite naturally having ripple effects through the resale market and so on. So, and the question we have is, how do people adjust to it? And in our view, there's a range of responses. And the most likely one is that people will choose something less expensive, but still be engaged in the housing market. And this may be behind the continued strong growth in condo prices. There's a bit of as Carolyn mentioned a minute ago, a transition at the margin from single family to condo in inexpensive markets. But that's I think going to be the primary process that happens, and that is also no doubt contributing to the flattening out of resale prices. Okay, so when we were in a phase where there was a lot of extrapolative expectations going on and lots of over the price bidding and all bidding wars, et cetera, then that was just had too much scope for a self-reinforcing price process. And as we're saying, that seems to have largely dissipated, although we won't comment on whether it's permanent or because the fundamentals of demand and supply are still very strong in the Toronto and Vancouver markets in particular, but not only there. So I mean, none of the things that have been done have been, and from the macro standpoint, have been aimed at house prices per se. They've been aimed at improving the quality of new debt and therefore gradually improving quality of the stock of debt. And in that sense, the effect on prices is more of a side effect, and that's more about demand and supply. And so the true way to address that is to address issues around supply.
Just to follow up on Kim's question about trade, there really isn't much except this glancing blow to global protectionism in the heat map section. Mm-hmm. And I'm wondering how that risk can be elevated but decreasing given the growing trade concerns that we've seen and continue to see that aren't going anywhere. Is it a difficulty in measuring this? Is this too hypothetical, or why isn't this a larger risk to global growth and financial stability?
No, as you know, the trade risk is our number one risk in the context of the monetary policy frame. So in the NPR of April, that was headline, that was the top risk, and nothing has happened since then to make it less important or less risky. And indeed, I guess I have to say on the contrary, it feels a little more risky today. So that figures prominent in our thinking about the outlook for the Canadian economy and what are the risks that we face to our forecast. But in that, when we go to financial stability risks, what we're trying to assess there is through a whole other lens, given the state of our financial system, what are the risks that are most prominent to it? And in this case, we're talking about systemic stability issues. And for us, what matters quite a lot in that equation is what is the macro backdrop. And it has steadily improved since our last FSR. And indeed, as we said just a week ago, that the Governing Council's confidence around the outlook has, given the data flow, continued to improve at the margin through time. And the confidence in our narrative, confidence in inflation, confidence in our understanding of how wages are behaving, et cetera. And so all those things go into that broader assessment that you're referring to in the FSR. Is trade risk still important? Obviously it is, but the channel by which it would be in affecting our economic performance, and then having that effect magnified by the vulnerabilities that we've identified in the report. So that's the sense in which it still matters. And but since 6 months ago, the macro backdrop has improved, and so that means that risk, as measured back then, it's not really that subject to measurement, but the perception is that it's improved over that time frame.
Okay, next question is from Yali.
Thank you, Yali Ndiaye, Market News International. I wanted to know regarding the risk of a housing price correction, given where the economy is now, and you've just mentioned that the background is stronger than it was. Is the Canadian economy in a better position to absorb a sharp? A lot of experts are qualifying sharp as like at least 20% drop in prices without falling into recession.
Well, we won't put any numbers to this, but we do conduct stress tests to using our models to just see what an impact might be in the channels through which house price shock might affect the broader economy and the financial system. And that's part of the risks that we have in the back. One is house price correction in Vancouver and Toronto only, with more contained types of effects, and another house price correction that comes through a recession that might be triggered by some external event to Canada. And so when we do that, I mean, it all depends on the size of the shock, but certainly we do find that the Canadian system is very resilient. It always has been, but I think that it's even more resilient than it was at the time of the crisis for a couple of reasons. And one is just the financial position and the risk management at the major financial institutions that are more highly capitalized and have more liquidity buffers. But the other thing that we're starting to see, which is positive and it's going to take time, is just the composition of the new debt that's coming out is a little more solid, in the sense that there are far fewer new mortgages that are being underwritten for people who would end up with a loan-to-income ratio of over 450%. And that's pretty good news. I mean, we've seen that from the B20 changes that were made in 2016 that are still working through the system, and then, of course, the newest changes that were implemented in January. So together, certainly, major house price correction is a risk. It wouldn't be good news for the Canadian economy, but from a financial stability point of view, we think that the Canadian financial system is resilient.
And regarding emerging market stress, so we've had outflows and we've had different episodes with fears of contagion. And I wanted to know, compared with last November, if the risk stemming from that has increased because of that.
Well, I don't have a handy metric to say whether it's increased, but certainly since then, we have had a couple of countries experience significant stress, that being Argentina and Turkey. I would say our sense of that right now is that, yes, there are you can observe signs of stress in other places too. The common denominator is that when U.S. interest rates are likely to rise, the U.S. dollar tends to strengthen. This interacts with some of those economies that have extra US dollar debt in their corporate structures in particular. So they've borrowed in US dollars, and yet they're operating in a local currency. And so the debt burden can go up rapidly if the US dollar rises rapidly. And so that always attracts the attention of those who speculate on those kinds of vulnerabilities. So I would say those vulnerabilities have been there. They're not, I would say globally, they're less than they have been in the past. And yet, of course, that doesn't mean they don't exist. They do exist. And so, I guess the thing about both Argentina and Turkey is that a centerpiece of the sort of speculation has tended to be around the independence of the central banks. And that makes it a lot more, if you like, less prone to contagion, provided that, another country's central bank is perceived as independent. And I think, in general, there is a pretty widespread sense that central banks are independent. But in those two cases, there were recent political developments that put those assumptions into question. So I think that kind of fueled the situation. Not out of all this expecting a contagious thing to happen, but I think everybody understands that U.S. interest rates are likely to rise, and so there couldn't be any more preparation for it than there has been.
Are there any other questions? Go ahead.
Just one last thing about the other vulnerabilities. You're still mentioning the non-financial corporations debt. I wanted to know if you think that we've seen most of the increase, and if not, is it going to continue to be concentrated in the oil and mining industries?
Yeah, I think what we want to monitor, so without getting into where we predict corporate debt to go in those industries, I think the reason that we're looking at it is you do see a rise in the debt-to-income ratios there as well. And of course, that's always a bit of a flag. It's not just for the household sector, it's for the corporate sector as well. And when you dig into it, as you mentioned, you do see that most of that rise is due to oil and mining industries. And as much because debt has increased, income took a big hit, not surprisingly, given what happened to oil prices a couple of years ago. And so that's a sector that we'll be watching. The rest of the non-financial corporate sector seems to be pretty stable. They've got a lot of cash. And when you do some simulations, you can see that their debt service ratios would be manageable or appear to be manageable in a rising interest rate environment.
Another question from Andrea.
Just on that auto loan note that there was in the FSR, I'm wondering how you interpret this lengthening of the terms, and yet arrears still look okay in those subprime borrowers. Is this a structural change in the way Canadians like to structure their debt, or do you think this could be some kind of sign that they are under pressure and need longer for some of those loans outside of mortgages and HELOCs?
Well, I mean, I do think that there's what we have observed is increased flexibility in that space. And I suppose in many ways, it's not unlike the gradual increase in flexibility we've seen in housing space. And it allows people to target their debt service ratio, which they can manage. And then just as they can buy the house that they've been looking for, they can buy the car that they've been looking for. And their focus is on, well, what is my debt service? How much is my debt service going to cost? The flexibility on the seller's side, in terms of lengthening the contract or offering, lower rates than what you would get from a bank, et cetera. That's all about, just how you pay for the car, right? So I guess if there's a concern, it's that, how much of a trend is this that people are turning in their old car and discovering they still owe more than what that old car is worth. And we know that's arithmetically a very possible outcome. And there's a noticeable proportion of the population for which that's true. So it's just another form of debt overhang. Just happens to be in the car space instead of the housing space or some other nondescript space. So far, it all seems to be, as you say, arrears are very, very low, so things would be running fine. And of course, in those cases, the interest rate that's in the contract is fixed for the whole time that you have that car, for as long as you have the loan outstanding. And so, I mean, I suppose if there were a strain or a stress at the point of renewal, it would be, well, I'm going to keep this car and I'm going to fix it for a year or two before making the move to buy a new car. But, you know, so again, there's more than one way for people to adapt to the situation that they face. And, you know, right now I see no reason to point at this as a major issue, but just something that we're going to continue to watch the data and collect. Is there anything you'd like to add, Carolyn? Okay, yeah.
Okay, thank you. That concludes today's press conference. Thanks to the governor and senior deputy governor, and to you all for coming.